Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, January the 31st, the 10:30 a.m. UAE time, the last day of January. The month's already gone. Albert Stromquist, principal at Landstrom Advisors, sitting in China. The world is it back to normal? China growing again in January, India at 6-7%, IMF increasing forecasts. The world is all as well, and so the sort of optimistic market outlook we saw through the month of January, we end the month and it all seems justified. What's the perspective from China, Albert?
Well, I mean, let's look at the reality. First of all, we're still in the midst of the Spring Festival. So people are just kind of crawling home now, back to work, back to school early next week. The purchasing managers index clearly has jumped back up over 50, which is a good sign. But just remember, that's a leading indicator. So I mean, we'll look for improvements in manufacturing sales and exports later in the first quarter as that index begins to yield results. Travel is back domestically, not to pre-COVID levels, but there was a respectable degree of both domestic and foreign travel, mainly by Chinese airlines to Asian regions and some further abroad to Europe and the US. Now, where is it going from here? The economic problems are really deeper than that. They are the result of 3 years of quarantine and COVID controls that left cities and towns near bankruptcy across China. The cities, municipalities were paying all the costs, bearing all the costs of healthcare and testing and quarantine during this 3-year period. And remember that the cities and towns are financed by their own captive special purpose investment companies, to which they have deeded the property in the town, and who in turn have borrowed vast amounts of money to pay the town for the property. When the property market is surging ahead, that model works fine. Otherwise, it begins to look like a pyramid scheme, and the cities and towns are left holding obligations for the debt that their special purpose vehicles have incurred. So this is a very serious issue that's not going to be resolved quickly. They have to work through it very carefully. There have been some policies offered to the property market to try to reduce the pain, but those haven't really had a time to take any effect yet. So we can only watch and wait and see where those policies take effect.
Narendra Taneja, India's leading energy expert. Narendra, the outlook for India remains somewhat positive. We have a report overnight that India Economic Survey for the year coming to fiscal year 23-24, slowest in 3 years, but still forecast to be well above 6%. Some solid growth still in the Indian economy, despite the backdrop of global recession in possible Europe and elsewhere.
Well, right. I mean, if you like, you're referring to the IMF annual forecast, and it's very good on India. It says that basically that India remains a bright spot, and that's the kind of sentiment you see across the country. Whether you talk with the government leaders, you talk with industrialists, or biggies in the oil and gas sector, for that matter, the renewable sector as well. Except if you talk with opposition leaders, opposition political parties, they have their own say, but even they struggle to find something concrete to say against the government policy, or for instance, the economic growth. But I think overall sentiments are very good, but we are keeping our eye closely on China. What happens when China is opening up, whether that would really result into crude oil prices going up, because crude oil prices always have a very huge impact on India's overall economy and fiscal deficit and economic sentiments. And at the same time, keeping a very close eye on what's going on in the Western part of the world, including the United States, in terms of the overall economic growth. I mean, here the sense is that, yes, they're facing some trouble, but probably, the US and Western Europe probably are not going to get into deep recession, which is being taken as a good news. Though the last 24 hours, the news from Germany is not very positive, where the reports are that probably the manufacturing is hit very, very hard. So, I mean, but keeping a very close eye. But overall, when you look at it in India, sentiment's very good. growth going to be close to 7%, which is not bad given the circumstances. And when you look at companies' investment plans, majority of companies are investing heavily, except a few private sector players. They're still waiting for something. We don't know what exactly, but before they start writing check, in terms for capital investment, they're still waiting. But oil and gas sector companies are investing, renewables, heavy investments going on, and at the same time, huge sentiments when it comes to renewables. And but overall, when you look at it, there are the sentiment, but the small manufacturing units, they are still suffering, they're still facing challenges, and they're still hoping the government will come out with some kind of incentive. We have national budget being presented in parliament tomorrow. They're hoping the government will kind of try to handhold for a little longer time. But agriculture output and the growth is very good, about 3.5%, which is tremendous for an economy like India. So I think overall, when you see the picture from New Delhi, whether the energy landscape or the economy landscape, it looks reasonably comfortable.
Yesar Al-Maliki, Gulf analyst at the Middle East Economic Survey. All of that, the world's two biggest populated countries, China and India, looking at growth figures north of 5% for China, north of 6-7% for India. And we have Brent crude oil still declining today, can't seem to get its head above $85 on Brent. What's the problem? Two biggest populated countries in the world back to big sort of Asia style level growth, and yet oil prices are coughing, struggling to stay above 85. What's missing here, Yesar?
Well, thank you very much, and good morning to everyone. Well, I think this is part of the consensus that we have. The consensus is that for the first half of the year, the markets are in surplus, and if we are going to see a deficit, then we are going to see that in the second half of the year. So even when it comes to our expectations of Chinese demand surge, that is going to happen in stages. I think by now everyone, the euphoria has died down a bit. I think Albert has shone some light on the dynamics in China in terms of economic demand and activity. At the same time, we understand very well that there is still a surge in COVID cases, but that is expected to fall and bottom out by the end of this quarter. So I think it is still too early for us, to track the oil price, to me at least, on a weekly basis for this first month. I think we will get to have a better idea by the end of the month or the first 2 months of the year. Remember, we still have Russian oil barrels going around. Russian oil production is strong. There has been they have made up for the losses in December earlier this month. And we want to see also the impact of the products embargo on Russia. So you have ample supply for this first half of the year. And, OPEC is expected to have a meeting soon, and they are not going to change course on things because, again, the consensus is still there. I think the point in time where we need to think really hard in terms of supply and demand, is going to be the end of the second quarter, beginning of the third quarter. By that point, we will see if indeed, we have better economic activity, inclusive of China and other places, and that would require more oil. But yeah, I think oil prices are still a bit not as bullish as the forecasts coming out for economic activity are.
Albert, the FT has sort of framed this as the China reset, and of course, there's many parts to that in order for it to add up to being a sort of return to what was from the point of view of consumption and growth, or some sort of better. The idea in the reset, of course, is some sort of re-engagement with the international community, not only through travel and trade, but also geopolitically. Your thoughts on where that reset is from the macro picture, because we still have an economy that is 30%. I mean, it's a kind of a mind-boggling number 28%, I think to be precise, of the GDP is dependent on the real estate construction industry. I don't know how they reset that. How do they reset that into a positive narrative rather than a seriously draining one that saw 30% of real estate value drop last year?
Well, thank you, John. Look, to your first question, the opening up is creeping forward. The Chinese are traveling again, but the country is still closed to international travel. So as far as tourism, international tourism, that hasn't happened yet, maybe later on this year. So they're taking a very cautious approach here to how they re-engage. There is a political re-engagement taking place, but the full scope of re-engagement has yet to be seen. The property market, to come to that question, is in crisis. And the steps that the government has proposed, I think something on the order of 500 billion yuan so far committed to mitigate the stress on a group of property developers, not the whole industry, but a select group of what they consider to be the better companies, it has yet to be implemented. Right. So we're not seeing what that effect is. And I think as we've discussed before on this program, the property market is heavily overdeveloped in China. Right? So that doesn't bode well for a surge in property values, especially on the mainland where that overdevelopment is very prominent. Now, the third leg of that historically here has been infrastructure development. Right? And there is some indication from the government that they will begin to look at new infrastructure opportunities, but given the depth of penetration of new infrastructure in China now, it's hard to see where that's going to occur in any kind of meaningful way. And then when you look at it as a driver of GDP, you say, is that really fair? Because the money's coming from one government pocket into sovereign-owned construction companies, who are then paying taxes back to the government. So it's really just cycling cash and then building assets in the process. But it's kind of sketchy as to how that works as an economic development engine.
Narendra, as we move forward, of course, like the US, I suppose, to a certain extent, certainly in India, we're moving into another election cycle with the parliament elections in 2024. How is that going to start to inform the economic outlook for India? One would think positively because the Indian government will continue to be quite generous in its subsidies. How do you see that playing out over the coming year?
Well, good question. You see, two things. One is, of course, you wouldn't be able to do much in terms of you have to carry on with the subsidies, even if you might to withdraw subsidies on, let's say, in certain areas, And what is more important that, when it comes to big reforms in oil and gas sector or in the infrastructure sector or the public sector, that probably you will have to postpone until the elections are over. Because when you're so close to the parliamentary elections, you don't want to do anything which might be perceived by a section of the populace as kind of, not good. Because we still have a lot of people in the country who kind of suffers from the socialistic mindset, because we practice socialism in this country for so long, unfortunately, I would say. So, but the real issue here is that when we would look at the fundamentals and the kind of, the animal spirit which has been unleashed, that would, of course, continue to play. And that is what basically is going to drive the economy. When you look at the economy today, of course, the government policies, management of the economy by the government is, of course, 24/7 basis, which has, of course, contributed and is a tremendous help. But the real thing is that India is growing, demand is growing, the size of, economy is growing. And at the same time, in India, when you talk to the young people, especially in Northern India, Western India, and Southern India, they all want to be entrepreneurs. For them, role models are people like Bill Gates or, Elon Musk and all that. So, and every day people are, want to get into some kind of startup, quitting their job, and they want to start something of their own. So this entrepreneurship, this new culture, that is changing the economic landscape in India. But allow me to just point out one thing on China. I think the real issue that the way we look at China is the perception. China might recover faster than, what, for instance, some people might have projected. But the point is that China today is facing huge issue in terms of how China is perceived by big investors and the, global community as a whole, whether you're part of the Western world or you're India, you're Japan, or you're Vietnam, ASEAN, or Indonesia, and all that. So most countries, most investors that I interact with, especially from the West and Japan, they don't want to kind of, put all baskets in China. They're talking of China plus. So they're looking for other countries for investments like India, Vietnam, Indonesia, even go, prepared to go even to Africa and so on and so forth. That is what is important. So I think the kind of politics and the economic policy that is being practiced by the present regime in Beijing is creating these kind of things, which might end up actually helping countries like India and Vietnam, Indonesia to attract more investment, especially from Western companies and Japanese and a few others. So which we look upon that as an opportunity. And at the same time, you see that happening across India, even in Bangladesh, you can see that, Indonesia, you see that, in Vietnam, of course. So I think that's a very important area, how the economic landscape, energy landscape is changing. Like, very quickly, last line, I want to point out, look at renewables, for instance. Our dependence on China for renewables equipment, especially solar, is close to 89%. But we have now come out with a plan. We want to bring it down to zero within the next few years. So gigafactories are being built for that. And we gather similar reports from other parts of Asia. And that's going to have a kind of impact on Chinese economy eventually. So a lot is going on. What eventually happens is the perception, and perception right now with regard to China is not very attractive.
Yes, sir. You said, of course, we have an OPEC plus meeting this week. It's actually not. It's the committee meeting. It's not the ministerial meeting. But nonetheless, it's a moment in which to reflect on what has been a massive change since they last met. I mean, at the end of the day, when they last met, their biggest customer, China, was still locked in a box. Now their biggest customer is out to play in a very big way for the year ahead. Why wouldn't this be a moment to revisit the decision to cut 2 million barrels from their quotas?
I think they have to look at the data, the market data, what's happening. As I said before, the reopening of China, the ending of the zero COVID policy is not going to happen overnight. The decision happened overnight, but the ramifications and the resulting industrial activity that we are talking about or expecting is going to take some time. And this is, this is one of the wild cards for this year with the Russian embargo, products embargo added to the existing crude oil embargo. So that's the supply side. The demand side now is all China. But remember, we are still looking at prospects of recession in other places than China, in Europe and in other countries. I know the results today, which I haven't seen, the IMF economic outlook is much more
revised up for the first time in over a year.
I think 0.5 percentage point. But again, this is the economic data are mixed up. We have better inflation data, but at the same time we have consumption continuing because of increasing labor activity, and that is basically because of shortages. At the same time, one very important component of inflation, which is energy prices, has been heavily subsidized in the Western world because of the energy crisis, because of the supply crunch with Russian gas. That was quite successful. The stocks were built to very healthy levels. Prices have been price hikes have been mediated. Have been supported. People got support packages and so on. So that also helped in reducing the inflation data. But again, I think going forward, OPEC, as I said in the beginning, they are going to look at data coming out of China. I think the most important thing, and this is continuing to be the sentiment, is that we have a good amount of surplus for this quarter and the next quarter. We have to see what happens in China. Then we might have deficits, and then I think there will be a change, of course. But although that could happen earlier of the Chinese demand and surge is quite strong. I mean, the Chinese import quotas have come in quite early this year, and they have come in quite highly, to independent refiners. And Chinese crude buyers are trying to buy whatever is available. And China is well endowed. You have Russian flows, you have the Malaysian blend, which is now Venezuela plus Iran plus Russia. So lots of oil going there. We will see. We'll see. I think we have to wait and see the data coming.
And of course, you also have all of the Iranian barrels that have gone into China at a discount, and apparently Chinese inventories are very full. So they have that forward cover with cheap Russian crude, cheap Iranian crude for that second half of the year surge. Perhaps they're well covered. Just to reiterate on that IMF report overnight, that the IMF said they revised global growth for 23 up to 2.9%, having previously forecast 2.7% for 2023. Still half a percentage point down on 2022, but a little bit better from the outlook of China opening. Let's go to the survey question before we bring up the other big subject for comment today. The Fed are meeting today. What impact will Fed softening have on oil markets? I mean, the Fed is, by all, unless some shock, horror, surprise, expected to reduce their tightening, soften their tightening quite dramatically down to 25 basis points, and perhaps even close to, if not arrive at, some kind of a plateau or peak rates. Certainly a serious softening in what was a very aggressive tightening in 2022. So the question is, what impact will Fed softening have on the oil markets? Will it be bullish? Will it be bearish? Will it have no impact? Albert, looking forward, I'd welcome your thoughts on that, and also maybe just pick up on one or two comments that Narendra made about this China reset. It's not back to what it was. This is a new dawn in which supply chains are looking to move elsewhere.
No, I agree. It's a new beginning. I don't think anyone expects to see China bounce back onto the trajectories that they saw pre-pandemic. Look, and we've talked about oil. I think Bloomberg put out a paper a couple of days ago. 11 economists have agreed that China will demand an additional 800,000 barrels a day in 2023. And I have to ask
myself, the IEA
myself,
forecast.
Yeah, look at it as a contrarian and say, for what? For what? For transportation, and for what? Captive power generation, for manufacturing. And that's where most of the crude oil goes here in China. For exports, yes, they'll probably continue to use arbitrage where it helps them to earn foreign earnings. But beyond that, if you look at the ratios between China's economic growth and crude oil demand over the past 20 years, crude oil has played a diminishing role in driving economic growth, GDP growth here in China. That doesn't mean that crude oil imports have been diminishing. No, they've been growing as well, but they've been getting a much bigger impact out of all of their other combined energy sources. And that's continuing to change. And there's an argument to be made that China could comfortably cap out at 15 to 16 million barrels a day and continue to grow and never need any more oil beyond that. So there's so many
even to get back to that would be quite an achievement in the current economic cycle, particularly when you consider their two biggest customers for anything made in China, the US and Europe, are certainly in economic stress.
That's right. Sorry, I missed my point.
I was going to just to take up the point. Does the rate cycle mean anything for the Chinese economy?
Not necessarily, although they're going to continue to keep their own rates low here in China, because to do otherwise would be counterintuitive. It would just exacerbate their already difficult economic problems.
Narendra, your thoughts on that question, that the Fed and most central banks, well, at least the Western banks, the UK, Bank of England, the ECB are expecting to tighten a bit more aggressively, but the Fed is softening. We're getting close to that, what appears to be that peak interest rate cycle, which will supposedly slow down the major Western OECD economies. Your thoughts on what the impact of that might be?
Well, I mean, if you look traditionally, and especially the last 5-7 months, we have seen that, Western economies and even economies like India, they blindly follow the Fed. I mean, when they increase the rate, they increase. When they decrease, they decrease. And in India, it's exactly the same pattern. And in fact, last time I was one of those who criticized it. I said, why are we just going, just copying them? So because our central bank had also increased the interest rates. So I think this time is going to be slightly different because we see the behavior. For instance, Indian economy is quite different. We see the similar situation in Europe. Britain is a different story. It's a sad story rather. Germany, these are some new developments. We don't know how Germany is going to react. But I think overall, the Western economies probably are going to go the same way as American Central Bank. But in India, this time probably Reserve Bank of India will not increase the interest rate. That's my guess, but you never know. Because the important thing is that Indian economy, the economy and democracy are closely aligned with the Western economies. So we just want to basically go the same formula. Our economists are trained in the same business schools as American, bankers and American Central Bank and Western Bank. So
well, all the Indian economists are all the Indian economists are all over all those banks anyway, right?
Exactly. So to answer your question, I think it will all depend on that. But the fact is that, when the central bank in India, they increase the interest, it has served the economy well. Now inflation is under control, especially the retail inflation is actually coming down. If you look at data of last 6 weeks, which makes politically, a good climate for the government, because inflation has been a big issue, public issue across the country. Now that we move into the election mode, this will become even more important. So if the central bank decides to basically, if the Fed decides to bring down, but I think Central Bank India might still decide to increase maybe by 0.5% or so, because here, whatever they've done so far, it has served the economy well. And right now the agenda is to make sure the inflation is kept under control, because when inflation is high and with oil prices not really going through the roof, I think they probably are focused more how do we control the inflation for ordinary Indian consumers. And that's politically the most important constituency for the government.
Going into an election year. Yasar, you get the last word with the survey result. Do the oil markets care about the Fed meeting today?
I mean, I'm going to agree, and they have voted with the majority here that no impact. I think, when it comes to these things, they depend on the sentiment of traders themselves. Some people would see, the Fed. What we expect is 25 basis points, rise. Some people will see that as not enough. Some people will want it to be, maybe not even a rise at all. Some other people would think, no, that is too dovish and you need to stay hawkish and raise further. So by the end of the day, it really depends on the sentiment of the traders. I think by now it is too early for us to say that, we have reached peak inflation, or we don't know how far inflation will go down more. We don't know if it's going to come up higher in the next months. So I think it's too early, and there will be no impact on no immediate impact. There will be some immediate impact in terms of either going up or down, but I think eventually averaging there wouldn't be really an impact.
Well, I'd have to sort of take some umbrage with that. I do think the impact of the interest rate cycle is still to be felt. The interesting data point I was reading over the weekend, I think I shared it yesterday, was that car loan defaults in the US are greater number. They're at 7+% now, much higher number than they were during the great financial crash of 08-09. The cost of money had 5+%, is still to really filter through to the economy, and with that obviously consumption and everything else. So a year in which interest rate and everybody's mortgage is 5% versus a year ago when it was 0 or 1% is a big deal. It just takes time to trickle through, a bit like sanctions on Russia takes time to trickle through and have a real impact. But I don't think one can underestimate the impact of 5% money. Sorry, you want to close?
Sean, sorry, I just wanted to have a follow-up. What
Please.
I meant was the immediate impact of the decision of the Fed, on oil prices. No, I agree with you. When it comes to overall, yes. And the signs from the US are quite cautionary, by the way. Companies are slowing down when it comes, to PMIs, when it comes to bringing, manufacturing, paying employees and so on. So it is still a very mixed picture. And eventually, of course, interest rates are going to have a great impact on the economy overall.
And we didn't even get to talk about Mr. Adani. That'll have to wait for another day, but a story to watch nonetheless, as something peculiar going on there in that story with the major, I think was the richest man in the world before this moment happened. Thank you so much. As always, Albert Stromquist from China, Narendra Tanea from India, and of course, Yasser Al-Maliki sitting in London. Really appreciate it. Oil prices trading this morning a little bit soft. Brent under $85 a barrel, but still stuck in that Goldilocks spot of around, give or take, $85 a barrel, which I'm sure every producer, certainly in this region, will be quite content if it's stuck at that and they could bank it for the year. They'd take it in a heartbeat. All the best. Thank you very much.
Okay. Goodbye. Thank you.
Bye.
Okay. I was on television, right?